Oh, smiling, smiling. Hi, everybody. This is Claire Barrett with Barrett Realty Advantage, and we have the good fortune of having Mohammad Ayaz from RBC Wealth Management, the Ayaz Wealth Management Group, here with us today. I have known Mohammad for, must be almost 20 years now.
16, I would say.
16 years. Yeah. He's been handling the finances for my family and my extended family for a very long time. And I trust him implicitly. He's somebody who is just really authentic and honest in everything that he says to people. So he's kindly agreed to come and talk to us today about wealth management through COVID, the COVID experience, but more importantly about the ups and downs of the market in general. So thank you so much for coming, Mohammad. Lovely to see you virtually, keeping our physical distancing going.
Exactly.
So let's start off with the first question. And again, this is an information session about financial planning. So can you please explain the difference between stock picking and an investment portfolio strategy?
Great question. Stock picking is the art of analyzing balance sheets of businesses to basically pick up the right ones, and so that we can pick up the right stocks to create or to maximize the return in our client's portfolio. As you said, investment portfolio strategy. It's a whole strategy. It's a process where you try to understand the client's goals and objectives. Then based on that, understand their time frame. And then based on that, you try to design the right mix of assets, whether they are stocks, cash, bonds, in the right way. That will achieve the client's goals and objectives, but also the most important thing is they are within the client risk appetite. Because you don't want to design, you can say, you know what, you need 9%, and this is this portfolio can do that, but it is so risky that the client will lose their sleep in the night when things what is happening right now. Okay, so it's a whole process. The stock picking could be a part of this process, but it is not the whole process.
No, exactly. And I think you hit the nail on the head here. There's lots of things that can make money in an up market, in a down market. However, there's no amount of money that can compensate for a lack of health because you're losing sleep at night. And it does prompt you to make bad decisions at times, myself included. So absolutely. Okay. So next question. I want to talk more about this investment portfolio strategy. So we all know the stock market has been taking quite a hit right now. Is it a time to change your strategy of your portfolio, stay the course? What do you typically recommend?
First of all, when your investment portfolio strategy is designed, it is designed for long term. It keeps into consideration the good times and the bad times. Okay. So the question is that if your advisor comes to you at that time and say, you know what, let's change the strategy. The question is why? Is the strategy not right in the first place? Number one. Number two is the advisor trying to tell you that they can time the market? Yeah, if they're trying to tell you that they can time the market, I would advise you to run as far away from them as possible. Because nobody
I agree.
Nobody can. Okay?
Yeah.
So the thing is, the art is to be disciplined. Stick to your goals. The most important thing, and I would say that I will keep repeating myself like a broken record during this conversation, probably, I would say.
I agree. Yeah, I get it.
Try to understand what is your investment mix. Why you have decided to stick to that. Number two. Number three is try to understand your investments, because what you are not investing in stocks and bonds, you're investing in good businesses. Now, good businesses can go down for a while, but they cannot be down for a long time. So the thing is, once you understand your investment strategy, the components of your investments, you know what, good times come, bad time comes, and they go. But your investment strategy should remain on its path. There could be minor changes that could be tweaked in a portfolio, but not major changes.
Okay. And I always, obviously I relate it to real estate. You know, it's the difference between somebody who flips homes, which has a short-term perspective, and somebody who buys and holds an investment property that creates dividends, i.e. cash flow, and capital gains, meaning increase in the price. And I can speak from, you know, my own experience, the experience of my clients, that old adage, when's the best time to get into the market 100 years ago, when's the second best time today? So it's a matter of looking at a longer term.
I would just add three things that when I was getting trained as a financial advisor, they say, you know what, you can do all these things, but you should be able to answer three things for the customer. Or you should ask three questions from the customer. What are you buying for? Who are you buying for? And when are you for when you are buying for, or when you are investing, right? So these are the three questions that form the base of any investment strategy.
Yeah, totally agree. Totally agree. Okay. Next question. So is there a way to mitigate these ups and downs and major corrections in the market? Meaning, maybe just temper how they would affect somebody's portfolio.
So the thing is, as far as the mitigate ups and downs of the markets are concerned, when a portfolio, as I said before, when the portfolio is designed, it is designed to take into consideration all these factors. There'll always be time when you will start questioning yourself, you will start doubting yourself, right? But the thing is, again, as I said before, I will probably sound like a broken record. You have to go back, look at your investment strategy. You have to look at what you are buying for. I give you my own example. When I came to Canada in 2001, and I became a financial advisor, and it was a sweet time to become a financial advisor. The dot bubble was bursting. So for the past, I would say I had my baptism in fire, I would say. I was, for the next 1.5 years, I was sitting in my clients every quarter, and I have to give them the good news that their portfolio has again gone down.
Right.
But what happened was in 2003, everything came back. Okay. So the thing is, and then in 2008, the same thing happened. And it was a very scary situation at that time. That investment banks that take 150 or 200 years to establish, they were gone in a week's time. So everybody was scared. Then what happened? 2009, everything came back again.
That's right.
I'm not saying that, the same thing is going to happen and next year we will be back to normal. I'm just saying that this shall pass too. The job of a good investment advisor is to hold the hands of our customers and say that, you have to understand, I can't control the interest rates, I can't control the markets, but I can assure you that you are in the right place and this shall pass too.
Yeah. And getting them into things that they would be comfortable with the fluctuations, definitely. But I probably say there's always been one event for any generation that has been sort of a defining event. And whether this will be it or not, I don't know. But the people who've stayed the course are the people who've come out ahead. You can do more damage, I think, if you make an emotional decision.
One strategy that I would also try to emphasize to mitigate the ups and downs of the market is dollar cost averaging. Now, for those clients who are already, like for our example, our retirees, they're already in the markets, right? So the first, whatever I said basically belongs to them, okay? But those clients who are in the growth phase, they are still young, they are saving money. Dollar cost averaging is a great way to be disciplined and take emotions out of investing. You are investing in good times and you are investing in bad times. You are investing every month, every quarter, or after every 15 days with your paycheck, right?
Every paycheck.
You ask me, what would I give to go back to 2001, 2002, and 2008 and basically sell my house and invest all the money in the markets, right? Same thing, right? So the thing is, these things happen and we just have to. Sir John Templeton, who's regarded as the father of value investing, somebody asked him this question. So what is the best time to invest? And he said, yesterday. And somebody then the same person asked, so what is the next best time to invest? And he said, today.
I agree.
So you have to understand that, markets go up and down. Whatever you are investing is today will give you the dividends in the long term.
Yeah. Yeah, I think the caveat to that though is you don't put all your eggs in one basket. Like having a
Exactly.
well-diversified portfolio is, I think, very important. No different than with real estate investing. And that's why I like partnering with you so much, because there's these things complement each other to a portfolio as a whole. Um,
When I analyze the portfolios of my clients, I always regard it as real estate as a part of the whole wealth structure,
Absolutely.
rather than
Hmm.
just the investments. And you
Hmm.
have to understand how real estate works and how it complements the other portfolio too.
Yeah,
A good
absolutely. I
allocation,
agree.
keep in mind
Oh,
those too.
okay. So now, can you just for our information, which sectors of the market historically do well in a recession and why?
The most common sense answer right now, which is always true in every session, is healthcare. Other things,
Okay.
yeah, because healthcare is doing well. The thing is, perhaps the two sectors, one sector that has been positive since year to date has been healthcare. So
Mm,
healthcare is one of them. Utilities are also one of them, because whatever happens, Bell is going to you are going to use the phone from Bell. I'm just using that as an example, right?
right.
You use the internet, you will use the television, right? Then we have consumer staples, we have food, and one new sector, I will say new because it is not that old, that will keep doing well in every stage of the economy is information technology.
Okay. Clarify what you mean by information technology, just so I understand. Are you talking like computers, or are you talking software? Or are you talking all of it? Or what is it?
I would say all of it. I would say
Yeah.
companies like Microsoft, companies
Yeah.
like Apple, companies that provide antivirus technologies,
Right.
So, so all these things, whatever the stage the economy is, they will keep working.
Mhm.
They will keep
Yeah.
using their services, right? You
Hmm.
are using your hardware. So let's say Dell computers. I'm just using that as an example.
Right.
So these companies, they have become such an entrenched part of our everyday life
Hmm.
that they do great in a good market, but they also do well in a down market too.
Because they help support us through the down market. I must admit, we have the realtors that I work with, we have an ongoing joke right now that we really wish we'd bought Zoom about 3 months ago, because we're all doing these Zoom meetings like 4 or 5 times a day, and we're conducting business through Zoom or Google Meets or something, and we're all like, man, I wish I'd bought that. But oh
Oh,
well, hindsight's 2020. Okay, so how can someone tell that the market is at the bottom? The
great.
quotes bottom.
As I said before, if somebody comes to you and tells you that they can tell you what is the bottom or what is the top, basically they are not human beings, they're gods. Because
Right.
nobody can do that. Even the markets, with all its wisdom, with all the whole information being centered towards the stock markets, they can't tell that. If they were able to tell that, we will not have the top of the market at in February of this year, right? And
Mm-hmm.
then in March 23rd, we had the bottom, and the market started going up.
Mm-hmm.
So even market can't do that. I will again go back to say the art is to be disciplined, to stick to your investment goals, to stick to your portfolio. And you know what? We have to understand that as far as the markets are concerned, the businesses are concerned, our population, all of this, whatever happening right now is an exogenous factor. But the thing is, the population is growing, the markets are growing, the businesses are growing, we are consuming more things. So the good businesses will keep growing themselves.
Right.
The one thing that you have to understand as far as recessions are concerned, I regard them as like you have a fever, right? What does the fever do? The fever fights with infection in your body. So what the recession does for you is it throws out the bad businesses from the market and it rewards the good businesses. So you have to understand again, the reason why I was telling you before that you have to buy good businesses is you have to understand what they have done in the past when such situation persists, when previous recession happens. Were they fast enough to change their strategies and they come on the
Mm-hmm.
top? Right? So this is how it is done. And I'm reminded of Warren Buffett's famous quote that when people are greedy, I'm scared. When people are scared, I'm greedy.
Warren Buffett.
Exactly.
Mr. Warren Buffett. Oh yeah, no, I totally agree with that. Absolutely. And it's funny you say that because, as I said, I've taken my business virtual, and I must admit, when people are hiring a realtor, I'm genuinely worried for those who don't know to ask the realtor that they're interviewing the questions for the new market. Because houses are being sold very, very differently than they were before. And I'm sure as investment advisors, the investment advisors who are not keeping up to date, who are not shifting and pivoting with where this market is taking us, unless their consumers really know, they're not going to interview properly. So let me ask you, in this pivoted business, what are some questions people should be asking investment advisors before hiring them?
First of all, they should understand whether they have the right education, they have the right designation, number one. Number two is that they have the right experience. You don't want to basically put your money in somebody who's just been in this business for the past 3 months. Okay. Yeah, I have seen that. I've seen quite a few things.
They got to start somewhere, but maybe not with a really big portfolio.
No, it all depends on what the size of the portfolio is. You're absolutely right. The third thing is, the most important part is, do you have the right chemistry with the advisor? Like any relationship, okay? You have to ask this question, whether this advisor is interested in me, is really showing an effort in understand who I am, what am I saving this money for? What is this money for? Or he's more interested in just shifting the business to him or herself. If the other thing is, when you ask an advisor that, give me your proposal. So does he sit back and basically said, you know what, let's do some financial planning first. I should know more about you, right? Rather than just give you a portfolio of stocks and bonds and say, oh my God, these are amazing things, right? Or on the second hand, whether they are just giving you that thing, the investment proposal, right? So the thing is, the most important thing is how much effort they are spending in understanding who you are. The fourth and another important thing is, although people emphasize that the most, I don't think so that is that much. It is important, but you have to understand why it is important, is the fees part. You have to understand what the fees, when the advisor is charging a fee, what is included in that fee. So let's say an advisor is charging you 0.5% this, and he's giving you an investment proposal, whereas another advisor, he's charging you 0.5% more, but he has a complete package of financial state, insurance planning. He's taking an effort in understanding you. He's using that knowledge to design the investment portfolio for you. Is more important than some extra bucks that you are going to save in paying the fee to the advisor. So these things you have to consider. First of all, the advisor itself, the education and the experience, the backgrounds. And number 3 is the effort that he takes in understanding you, and number 4 is the fee that he charges. He or she.
Okay. And again, just to relate it to real estate, when I work with buyers, they're always like, why do we have to have this meeting? And I say, because it isn't about my job, my value add to you is not opening doors and getting you in. It's about being able to interpret the space and relate that to your needs and wants, if that works. Because I've seen people walk in and they go, oh, I love the kitchen cabinets and I want to buy this house. But they're not looking at the fact that there's not a lot of them. And there's a family of 5 and one of them is a chef, and there's a lot of, you know what I mean? So I totally relate to what you're saying. So having somebody who is actually asking about what your needs and wants are, I think is key to any customer service role, okay. Now there are other parts to a good financial plan other than just the investment portfolio. Can you talk a little bit about what those are?
There are about, I would say about 7 parts.
Oh, really? Okay.
Briefly into each one of them. First is cash flow planning, which I would say is the key of any good financial plan.
Definitely right now.
So
Because if you
what I
didn't
do is
adjust for your cash flow requirements, you were in a
exactly
pickle.
where's all the cash is coming from and where the cash is going to. And it is a great discovery
Yeah.
tool for the clients themselves. So I sell them an Excel spreadsheet about, okay, give me the idea about your expenses and your incomes, right? And then I say, you know what, make a copy and think that you are retired. Even the retirement is 20 years away. Think about that it is, you are retired today. So what are the expenses that you would not be incurring and what are the expenses you would be incurring so that we can have a retirement target? A retirement target is not something from the blue sky that you pick and you say, you know what, I need 60,000 or 70,000. You have to invest some time in understanding what will be the life that you'll be looking for in the future. Okay.
Right.
Second thing is debt management. It is also very important because it encompasses whether you are in the right debt product, whether you are too much indebted. Is there a way that you can move your high interest debt to low interest debt? Are you paying your low interest debt first rather than the high interest debt? So all these questions becomes part of debt management. Then, of course, the retirement plan. And I said before, it goes hand in hand with the cash flow, right?
Right.
What is your retirement target? Do you have enough for that? How much do you want to save? Whether your cash flow allows that? What could be the strategy that we can use? And so on. State planning. Um, uh, uh, this is, I would say that this is one factor that most of my clients, especially those who are young, basically have or try to avoid that. This should not be the case. The way that I scare people is that I ask them,
I like me being honest that you scare them.
you know what? Sometimes
That-
an advisor has to scare their clients, right?
Sometimes.
So the thing is, I ask them the question that, tell me one thing, if you have kids and let's say, God forbid, both of you passes away, and think of a relative in your family who can go to court and say, I want to take care of it.
Yeah.
And you know what? There are always one of the two of those guys in a family, right? Because if you don't have a will, if you have not assigned guardianship for your kids, that guy has a right to go to the court and become the official guardian, right?
You know my family, Mohammed, so we're like not even touching this.
So the
But
thing
it's
is,
true. I think it's the most important part of a financial plan, honestly. It's not about the money while you're here and what your money will do, especially when you have a family. It's because
exactly.
you have those choices in your hands. But God forbid you're not on this earth anymore and your responsibilities live on, you no longer have the choice. And the only way you can make sure that your goals are being seen to after you are gone is through a good estate plan. I think it's critical.
Have you reviewed even your will is there? Sometimes the will is old, but it's 15, 20 years old, right?
Oh yeah.
It
Yeah.
needs to be reviewed. It needs
Yeah.
to be changed. Things have changed, right?
Yeah.
And through this thing, we push the clients to basically understand their state objectives and look
Right.
lean at their will and make changes if there's necessary.
Yeah, no, totally agree. I think it is critical. Okay, so is there anything else? Any other part of financial plan
Insurance
we need to
planning,
cover? That's about it?
planning, that is, are you rightly covered? There are two parts of insurance planning. One is risk trade-off, that you don't have enough assets. You should have the money to, the insurance part should take care of, God forbid, one of you passes away. And the second part is basically legacy. So you know what? Insurance could be a part of your asset. And that would be through which you'll be able to transfer your legacy to the future generations. Then there's tax management, whether your investment portfolio is designed in the right way, whether,
Agreed.
you know what, all your stocks should be in your non-registered accounts and all your interest bearing securities should be in your RSP account, so that you are not paying too much taxes. Okay,
Right.
so this is part of that. Education planning. So you have young kids. Have you properly put aside money for them? What should be the investment strategy? Are you making regular changes in the investment strategy as they are going closer they are getting closer to graduation. One thing that, and investment management is the part and parcel of all these plans, okay? Number
Right.
one. One thing that I always have a beef with the Canadian education system is
I
that
know
we
where you're going to go.
should introduce financial planning courses in high school.
I totally agree.
When kids are going basic financial planning, when kids are going to college, they should, or universities, they should know what is the meaning of cash flow management. What is debt management? The credit card is not free money. You know, these kind
Yep.
of, it should be part of the curriculum, you know, which I think we are lacking from that perspective.
I sent my two older children to a day workshop about financial literacy for children, and I think they were about, I don't know, about 10 and 12 at the time. And I consider myself, you know, I worked in banking for a very long time, work with a lot of real estate investors. I consider myself to be pretty savvy about these things. And my children came out of it, and I was shocked to discover that they didn't understand the difference between a bank card and a credit card.
You're absolutely right.
And I was like, what have I done? So no, I agree. Financial literacy, and I tell all my clients who are real estate investors and they have children, I said, listen, when we talk about the benefits of real estate investing, I say the best benefit of this is actually teaching your children this.
You're absolutely right.
So, you know, you might be 60 years old, but if you've got kids who are in their 20s and you can pull them into this and the same with your stock portfolio, include your children to some extent in these conversations, allow them to become financially literate. So and to that end, you know, as you know, I have two kids who started university. They're both in university at the same time. Man, am I ever glad I have those RESPs because there's no way.
My second kid is now finishing university. You know, next year is going to be the last year for him. But the thing is, if I wouldn't have saved before in the RESP,
oh, I know.
Yeah. For me.
Yeah, yeah. Especially now that so many kids are going away to university. I mean, it's room and board as well. It's not cheap. I'm buying my kids a house, so I'm not paying the school and money anymore. I'm serious. I'm buying a house right near their university. Going to rent a couple of rooms out. It'll carry itself. And my older son is participating in the purchase and the investment because this is something he wants to do. So again,
it's a great idea.
Yeah, I'm hitting everything all barrels. So, okay. So now, if we're having a little bit of trouble during this time right now, because you know there are people whose incomes have dropped considerably. There are some people who are only doing only getting the money from the government. If we're having trouble making ends meet, are we better to withdraw money from an RSP, a TFSA, or general savings at this time?
Great question.
Is there an answer? Is there a clear-cut answer to that?
There is an answer to that. This is a very pertinent question, number one. Number two is that I would first, you know, I talked about the cash flow planning too. So I will first go to them and say why you are having this issue. Is this something that that could have been managed before and you have not looked into that? Okay. Because sometimes we don't manage our finances properly.
That's right.
Number two is, based on that, first of all, you have to design a strategy. Like in these, I always advise my clients to have money equal to at least 6 months of their expenses in a form of an emergency funds. Now, people used to laugh at that, right?
No.
Why should we have that? You know, we have this, we have that, we can find another job. Can you go out and find a job in these times? You know, so the thing is, you can use this time to get bogged down, or you can use this time as a learning experience too. Right?
It's a painful learning experience, I got to tell you, though.
Exactly. So either in the form of money stash aside, or in the form of a line of credit too, I would say, in whatever way that you can, whatever way your finances allow you, you should have at least 6 months of expenses stash aside. Secondly, when you come to the question of whether you should take the money out of the RSP or TFSA, I am in that block that was always opt for TFSA. I think TFSA has been a great tool that has been given to us by the government of Canada. The reason is when you take money out of RSPs, you have to pay taxes.
Right.
So first of all, there's a big cost of taking that money out of the RSP account. Secondly, um, you can never put the money back into the RSP. So you have lost that advantage of that money growing tax-free for the years to come. Secondly, in the tax-free savings account, the advantage is when you make a contribution, it is with your after-tax money.
Mm-hmm.
Although it is earning tax-free income, so when you take out, because you have put the money after taxes, the
Mm-hmm.
contributions, you don't pay a single cent in taxes. So you take out 5,000, you get 5,000, okay? And secondly, you will always have the ability to put the money back. So let's say you take the money out today, you will not be able to put the money back till December 31st. But from January 1st, 2021, you can always put the money back. So next year, let's say the contribution limit is 6,000. So 6 and the 5, you have the money, you can put the $11,000 back, right? So it has that flexibility and that cash flow efficiency, which is you're not paying any taxes, and you have the ability to put that money back. That I will always go for the tax-free savings account.
Okay. Oh, great. Thank you for that. And it's funny you say that, because as an entrepreneur, I was very, very fortunate. I, because I work with you and because I have this experience, I had enough cash to carry my business for a year. So I know that I'm safe, but there are a lot of entrepreneurs who are not going to come out of this because they didn't do that cash flow management. And it's very, very unfortunate. So if you're in that situation, then I strongly urge, reach out to Mohammad or reach out to an advisor with a bare minimum his qualifications, and have a look at that. So, unregrettably, there's no way to avoid the hit right now, but there is a way to make sure that you're positioned well should something come up again in the near future. So, all right. And now, is there anything else you think we need to cover today, or do you think we've got it all? I think we did pretty good.
I think just stay calm. This shall pass too.
This too shall pass, absolutely. And try not to go to the fridge too often.
Exactly. And I need that.
Yes, so do I.
Advice.
Well, listen, everybody, thank you so much for joining us. Mohammad, I really appreciate your time today. Thank you very much. There is a link in the chat box over here if you would like to reach out to us. I will put Mohammed's contact information in there. And we do appreciate, again, really do appreciate your time today. Thank you so much. Please stay safe. All the best to your family. Happy Ramadan. I hope you can eat soon. And he warned me he might be grouchy. So thank you very much, Mohammad. I really appreciate it. And I will talk to you again soon. Okay.
Anytime. Thank you.
Thank you. Bye-bye. And there, I just finished the recording.